Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On tonight's program, I've got Mike Gable of Fairmont Equities, who's looking at the charts and he's looking at the market indices, that's the S&P 500 and the ASX 200, to see if these markets are actually getting near the bottom. Is it time to start thinking about buying into the market? And then he runs his chart spotlight over Xero, which had a bad day in the market today, IDP Education, Magellan Financial and Macquarie. All these stocks have copped it, but are they getting into the buy zone? That's what we test out with Mike Gable. Then Paul, Rickard and I talk about whether it's actually too scary to invest right now. And if that's the case, when should you think about doing it? Then Simon Pressley, the founder of Propertyology, he reckons all this talk about house price crashes is way over the top. And he's got a pretty persuasive argument. That's later in the program. But then we follow up with the senior economist at REA Group, Eleanor Creagh. She's a tad more negative, but she's also not talking about crashing house prices. And in fact, she looks at places where house prices are actually rising. That's the show. Let's kick off now with Mike Gable of Fairmont Equities. Thanks for joining us, mate.
Thank you.
Pretty volatile times, and I've asked you to look at some big picture charts and some smaller ones as well. And I usually ask you for a tip at the end of it. We'll see what you have to say about that when we get there.
No worries.
But let's just kick off with I think the heart of the problem, namely the US stock market, the tech stocks that drive the S&P 500. What's the outlook for the poor old S&P 500 at the moment, mate?
It is looking a bit sick, unfortunately. Yeah. I mean, when we spoke a little bit over a month ago, everything was sort of bouncing off support and looking like it might hold in there, but clearly things have broken down again. And what I've got here is a daily chart of the S&P 500, and it goes back a couple of years. What I wanted to show at the far left was that peak that we had just before COVID. Yep. And as everyone knows, it blasted through that and went on a great run. But most recently, what we've got here is clearly a deterioration. I mean, when we had the bounce there around March, it looked like it might have legs, but it's come back to that support level.
Like it was like a bigger version of that, which was like the launching pad for another takeoff. Yeah. And I figure what you're going to say is, if the news had got collectively better over the last 2 or 3 weeks, that may well have been a launching pad for another takeoff. But the news hasn't got any better, has it? Yeah,
that's right. So it does look negative. Yeah. I'd say there's clearly the trend is to the downside. The risk is to the downside for the moment. This blue level here, I'll just stand up and show our viewers. So basically we've had, this was that major support level that we needed to bounce off, but instead it's fallen through that and it is looking quite weak. So we may well get some bounces over the next few days, but if it tries to bounce, it can't get back above this line very quickly. I'd say we may well just see a bit more of a capitulation. This whole pattern reminds me of the end of 2018. As you recall, rates were supposed to be heading higher, and it wasn't until the US Fed sort of backtracked on that.
To be precise, Donald Trump twisted the arm of poor old Jerome Powell, and he capitulated.
Put him in a bit of a headlock. So, look, I mean, part of me would just be happy to see this capitulation, just get it out of the way. So, what I mean by that is, a swift move to the downside while everyone gives up, and that would lead to a swift bounce. But right here, it's too early to be calling any sorts of lows. As I said, I think the risk is that we get some kind of dive from here. I mean, I don't know if it's going to stop here or here. That's impossible.
What you don't know, and I've got you here as my expert. I don't believe that.
Yeah, look, I think a lot of people can. A lot of people try to predict levels, but it basically backs you in a corner.
That's right.
I think what's clear is the direction. The direction is down. Let's just observe that for now. I don't think we need to rush into buying anything until we see a lot of sort of giving up of the share market. Maybe that's only a few days away, hopefully. Short answer is downside for now.
And there was an important test last night, namely the inflation number. That inflation number, which came in at 8.3 rather than the previous one, 8.5. If that number was, say, 6.5, this market would be going up today.
Yeah, I think a number of analysts or market commentators we're all hoping for a better number than what we got to just ease this, but clearly it is what it is, and we're going to.
It is what it is until it's not.
Until it's
okay, let's go to the Australian market. We have not suffered to the same extent as the poor old Americans. So this is the S&P ASX 200 index. What are we seeing?
So it's almost the definition of volatility, isn't it?
Right.
So our market obviously holding up better because of the resources sector. So we still haven't breached that low from January, February, but we're getting close to it. Maybe this is where we bounce, maybe not. But essentially, I think this is what we're going to see for most of the year. So I think at the end of last year, because of the reduction in QE, because of rising rates, I was expecting a year of ultimately nothing, but a lot of volatility in between. So I think this will continue on. Bear market rallies can be some of the most powerful rallies you see in a market. So for someone like me that likes to trade, I think it could be a good year in trying to trade these ranges. But ultimately, I don't think we're going to go anywhere in a hurry.
Yeah, so you're saying that if a good company gets smashed, it could be a buy, but you don't hold it for too long.
Yeah, exactly. I mean, I think we need a major catalyst for the market to start trending again.
Yeah,
and,
like the end of the Ukraine war, China getting out of lockdown.
Well, I think potentially just backtracking on all these interest rate rises.
Yeah, exactly.
So we can make a case for why the Fed Reserve should do another couple of 50 basis point rises in a row, and the others that should follow. But if they backtrack from that slightly because economies may well get tipped into a recession, and that's what the market's starting to price in, the fact that we may well be having a recession on our hands. I think if they start backtracking from all these rate rises,
so 10 rises to 6, the market will say, hey, that's good.
It'll be back on the happy juice again.
From a low level. And by the way, we made the point in the show plenty of times that the growth of the S&P 500 out of the coronavirus crash was excessive. Like we were up about 5 or 6%, they were up about 35%. And the tech companies were driving it, weren't they?
Yeah.
Okay, let's go to the next one. And this is a company that's, struggled. I've noticed that people want to buy this around 14 and it can bounce up to 16 or so.
Yeah.
What are you seeing? This is Magellan, of course.
So I've brought a long-term chart here. I mean, when I look at a shorter-term chart, it seems to be leveling a bit, but at best, I think in the short term, you might get a bounce to sort of $20 and a bit of selling. But again, just if we look at the long-term chart, we can see that it is quite sick. It needs to do a lot more base building before it can get going. It might need to do something like this. And when you think of it logically, with their underperformance, with all the the musical chairs that have been happening within the business. I think if you're an investor looking to put your money in a fund manager, you wouldn't be picking Magellan today. You'd be giving it another year or two. So I think it's going to take time for their funds under management to get up, and therefore the share price to get up. So at best, I expect this one to do a bit of that for a while.
Yeah, and it seems to me it's like the kind of company that if you want to take a risk on it, you want to be paying for say $14 and hoping that it sneaks up to 16, which it has been doing. And that's not a bad return, for a year. But for it to get back into the 20s and the 30s, you're right. It's going to have a much better track record than it's had in recent times.
Yeah, exactly.
We should also make the point is that a lot of its spectacular growth was when tech companies and Chinese companies were doing really well. They have suffered because of the coronavirus, the slug on Chinese companies in particular. But still, there was some other issues there as well. Let's go to the next one now, Macquarie. This is a fantastic company, probably in the buying zone for anyone who hasn't held, I hope they were in the buying zone for people who haven't had Macquarie, but what are you seeing?
I guess just like our market, just in a range, getting to the bottom of that range, which is quite clear for everyone to see. I guess if we were to break these lows, you'd expect a bit of selling to start to kick in. This is where a lot of people would have stop losses. Up until here, it was actually, I thought it was doing pretty well. It was holding up on good volume. The result wasn't bad, but as we know, it just unfortunately came out on a day when the rest of the market was falling back quite sharply.
And the CEO wasn't prepared to be over the top. She was quite cautious in the outlook, and the market didn't like her caution.
Well, I mean, for anyone that's been following Macquarie for a long time will know that they don't give guidance. In those sorts of situations, and they don't, overpromise.
They don't gild the lily.
Yeah, exactly. So, I mean, that wasn't a surprise to me. So, look, it's at the bottom of the range. If you're a holder of Macquarie, it's okay. Well, it's back down here. Maybe you'd be looking to buy a bit more of a bounce if the market gets going again. So, this one doesn't really concern me because of the range. It would have to break this for me to get concerned. But then, as we could see, if we look back, in the middle of last year, there was a lot of price action happening, only about $20 lower. So you could assume that if we get a capitulation in the market, you'd get a spike down here, but it would bounce pretty quickly.
Yeah, if I saw it at 160, 150, I'd be a buyer of Macquarie without a doubt. He said, so am I. And I think the important point to make also is that 70% of Macquarie's money now is made overseas. So what's going on in the S&P 500 isn't great for a bank that makes a lot of money as an investment bank in New York City. So that's another part of the story as well, I'd say. Let's go to IDP Education, IEL. Now, a lot of people asked me about this. I know at times it's been very a darling of the market, but I know it's struggled of late. Is there any signs there of positivity?
Not yet. Peter, I mean, the only thing that, it's in a downtrend, we can all see that. I'm not seeing the downtrend slow. When I look at sort of this part of the chart, it reminded me a bit of the S&P 500, if you recall, sort of this bounce up here, the break of support.
And then collapse.
That's about it, really. Yeah. So I think this one will get cheaper. We don't need to rush into this one.
Okay. Now, Xero. A company I really like, reported badly today, and I think it shows up on the screen. Yeah. Before that news, were you seeing anything positive about Xero?
Yes and no. I mean, I have to admit, I think when I was last on your show, just over a month ago, Peter, I said I was buying Xero because it seemed like it was basing here, and then it broke above that base. So the push above $100
you gave yourself a ticket for that.
For me was a buy. Yeah. Unfortunately, in the last few weeks, we could see that it fell back into this range. And then last week when it broke under this, I advised my clients to take a loss and sell it. So I just don't, for me that's a negative, the way it's trading like that. And it's the type of company I don't want to muck around with because it can move quite swiftly in either direction. Yeah. And as we speak, I think it's down about 12% again just today. So it can move very quickly to the downside. So unfortunately, I've taken a loss on Xero. We'll see where it wants to establish support. But obviously the environment's not good for these sorts of stocks.
Okay. Now, when you come here, I always say, give us a stock that you're interested in. Yep. What's the stock you're interested in?
Well, I'll have to sit back down because I don't have a stock this week. I just think
which is unusual, ladies and gentlemen.
I normally have a mining stock or something interesting, but I just think the broader market is very risky at the moment. As I said, hopefully it all gets resolved in the next few days and we can get a bit of a bounce. But even then, that'll probably be a bear market bounce.
You're saying as though you're coming from the Peter Switzer School of Optimism in the next few days. Even I'm thinking it might take a couple of months.
Well, all these things will pass, of course, and there'll be opportunities. But at the moment, I'm not seeing many. We've been, ideally, I think you should be in cash at the moment. Me personally, I'm just in cash.
You've sold everything. Have you sold everything? Have you?
Yeah, but I could buy back in tomorrow pretty quickly. It doesn't worry me. But with the clients I advise, we've been saying, look, I know, 99% of you won't want to be 100% cash. There are certain stocks you want to hold, but I think in this environment, if you can cash in what we call the high beta stocks, so stocks that move say more than the market. So if the market's up 1%, this stock might move more than 1% in either direction. If you can get rid of those stocks and reduce the beta of your portfolio to less than 1, what that means is if the market drops 1%, you might only drop 0.5% because you've reduced your beta. And usually the easiest way to do that is reduce your high beta stocks. So there might be a few stocks in every portfolio worth getting rid of. Xero was a classic example. The market's down, 1% today, Xero's down 12%. So if you could raise your cash levels, even if it's just a 20, 30%, that can reduce the beta of the portfolio and just reduce that downside risk. So I think, but obviously the flip side to that is you then need to be prepared to get back into the market. You can't just dither while it runs away from you. So,
and of course, for people watching you and wondering why you do it, you are a more short-term oriented investor, aren't you? And you intend to accumulate your profits over your trading period by getting in and out. Where a long-term investor might look at Xero today and say, that's a great price. I think it'll get back to 100 in a year. If I can make $23 on 77, that's a nice 1 year return. That's what a long-term investor might look at and see.
Yeah, so a lot of our positions, I'd like to call them maybe more of a medium-term position. So it might be 3 to 6 months for some positions. There'll be other stocks we hold long-term, others a bit shorter. But yeah, you're right. That's how we try to do our thing. So talking from someone who looks at things a bit more medium-term, let's say, I think it's worth having a bit of cash and waiting for the market to bottom out, and then we might get a nice explosive rally for several weeks or so that we could take advantage of. But at the moment, I think the risk is to the downside, and we just have to
keep our
take it as it
crossed.
comes.
A good circuit breaker, a positive event like the end of the Ukraine war looks unlikely at the moment. China must get a lockdown eventually.
Yeah, we've seen the World Health Organization for some reason decide to be critical of China and their zero COVID policies. Yeah, look, I'm not sure how quickly they'll come out of lockdown. I don't know what the catalyst would be. Maybe the market just gets so oversold in the next few days or so that we get a bit of a bounce. But I think a sustained rally would have to do more with the direction of interest rates.
Correct. And I think, there's something you and I were talking about earlier. This accumulation of negativity around the stock market, we know has affected consumer confidence in Australia. It will affect consumer confidence right around the world. So all the people who are predicting, for example, 10 interest rate rises in the US and 6 or 7 here, may well be, in a sense, helping us have less interest rate rises, and that's what the stock market might eventually react to if by September, October they say, hang on, we were far too negative, and that market's been sold off far too much because interest rates are going to go there. Yeah. So that could be the kind of fillip or catalyst that turns this market around.
That's right, and I don't think we've seen a situation where reserve banks, central banks across the world have raised rates during a major bear market. I think you have to go back to the 70s. Yeah. I wasn't in existence then, Peter, but you'll have to correct me on that. But I think it'd be very unusual.
I think Paul Volcker was the Federal Reserve boss.
So it'd be very unusual for, stranger things have happened, but it'd be very unusual to see these sorts of interest rates in a market that's on its knees. Normally the central banks come in and help out a bit.
But isn't it interesting, the reserve banks are caught between, they're behind the curve, they've got to beat inflation. But they could be causing a recession. It might explain why the Reserve Bank governor gets paid over $1 million a year.
That's
right. Okay, thanks for joining us. That's Mike Gable, Fairmont Equities. Well, we just heard from Mike Gable. Now I've got Paul Rickard in to tell us whether he's afraid of the market situation right now. What do you reckon, Paul?
Well, I'm not afraid, Peter. I mean, it's obviously, it's a little challenging because we're getting such negative leads from the US, and we'd like to see that inflation number coming down a bit more than it has. But look, I think you still got to say that the Aussie market still looks all right, but it's going to be a tough little short period. I mean, tech stocks, a lot of companies have been really badly smashed. There's obviously a little bit of panic selling. And, you just got to be, the strong stocks are doing okay, and you've got to stick with the strength here a little bit.
Yeah. on that subject, you and I both liked Xero and it reported badly today. Have you had a chance to have a quick
Yeah,
look?
look, I mean, I think that they're being a bit hard on Xero. I mean, what they're looking for is they want every company to be profitable. Now, Xero's reinvesting,
Yeah.
and you know, it provided guidance in terms of its operating margin next year, and said that expenses as part of sort of revenue would be between 80 to 85%. That's it's currently about 86%. Now, the market thinks it should be a lot lower than that because, you know, if you're not investing, then you can, you know, the margin should be higher, and that's what the market's sort of punishing. It says that we want to see more immediate profit, and the Xero is saying, look, we're investing for growth, and so growth is just out of favour.
Yeah.
And you know, the market's got high expectations.
If someone doesn't own Xero at the current prices, do you think it's not a bad entry point?
I think on all the custom metrics, yeah. I mean, I think it is a good entry point. My caution, only caution is if, you know, we get more negative nights on the Nasdaq, all the tech stocks here are going to get smashed. But I think it's a good entry point at the moment. I think today's reaction is a bit is unsound, overdone, and the market will come back to that.
The only reason why I ask that question, because sometimes when you get some bad news, you often get a run of bad news. And
I don't think there's any much bad news. It's just not the news the market wanted.
And that's a good point.
So, you know,
not like a shock
on the actual numbers, you know, the growth number in terms of number of new customers, in terms of average revenue per user, they're all pretty strong.
Yeah.
It's just that the market suddenly expects, you know, companies that have been in growth mode, building businesses suddenly to become super profitable. Well, you can't do that overnight unless you get rid of people.
That's right. No, I've got to say, the analysts really like Xero. I think not any analysts have a negative view on Xero. And you and I believe it's a company of the future, and therefore, okay, we don't have to make money this year, but over the next 1, 2 or 3 years, we would expect to see that share price a lot higher.
Yeah, I mean, and again, I'm probably the obvious caveat. You know, you don't necessarily use all your firepower at once. You know, but look, I think that's one of the companies to look at, and you know, in what a sort of is a tough market. We're going to be in a tough market for a little while.
Getting away from the more risky companies, Paul, I know I was asked today by one of my favourite investors about Wesfarmers. Is Wesfarmers in the buy zone? It looks like it.
Look, it's holding in pretty nicely. I'm not really ever sure why Wesfarmers got over $60.
Yeah.
And it's now about 49, and it really hasn't done much. It hasn't gone down, right? No. Despite the market fall. So look, Wesfarmers I think is looking reasonably attractive. It may not, you know, if you look at the stocks that are doing well on the market, they're clearly the banks because of, you know, people expect margins to improve as interest rates go up in the short term. Some of the, you know, your classic sort of big first level, you know, companies like Wesfarmers and JB Hi-Fi is doing okay. BHP and the others are doing okay, and everything else.
It's like defensive quality, isn't it?
CSL's doing right. Everything else is sort of getting smashed a little bit, right?
Yeah.
Woolworths is doing okay.
Well, you mentioned banks, but a lot of people were wondering whether this is a good time to buy Macquarie. It's got down to a buyable
price.
I
think Macquarie, as a portfolio stock, yes. As a trading stock, maybe not, because it's you know, it's more exposed to the external environment.
S&P 500,
Yeah, and so if the external environment stays, you know, pretty tough, then Macquarie will get hit. But I think as a portfolio stock, I think it's one of the top 2 or 3 companies in Australia. And you know, you look back and dips have been bought, and this is a dip, and this is good reason to buy it. So you can read an article on that today in the Switzer report.
You wrote something exactly on that?
Exactly.
Well, there you
go. There you go.
The Switzer report. Is it Switzer Today or Switzer report?
Switzer report, if you get a free subscription, I think. But anyhow, have a look at that, and you can look at what I have to say about
And one last thing, you mentioned buying the dips. I read one story today where the writer said, you know, it looks like the buying the dip strategy is over. I don't think so, Paul. I think it's always a good strategy. Yeah,
I mean, the US, I think it's still, you know, if you're a long-term believer in stock markets, you look at long-term charts, they go up. And so whether the dip is 20% or 30%, you just got to have patience, right? I still think that's the right strategy. That's what equities have done classically over the long term, and you've got to hang on to that, right? But you've got to wear a bit of pain. So, I think a lot of people come to the market and expect them immediately every buy they're going to do as a winner, every sell they're going to do as a winner. I have never bought at the bottom or sold at the top. It just doesn't work that way, right? And every time that you're on the market these days, immediately you're out of the money because it's just the way it works, right? So you've got to take at least a medium-term view, and even as a trader, you've got to have a bit of patience too, right?
I must admit, Paul, I tipped BHP at $14 many years ago, but didn't buy it until about $15.70. But still, look at where it is today. So often the worrying about whether you're getting at the bottom or top, not really relevant. Just by quality companies when the market doesn't like them. Thanks, Paul.
Thanks, Peter.
That's Paul Rickard of the Switzer Report. Well, joining me now is Simon Pressley from Propertyology, and he's basically telling people all the negative headlines around house price collapses in the future because of rising interest rates possibly is an exaggeration. Let's just hear what Simon has to say. Hi, Simon. How are you going?
Oh, I'm very well, Peter. How are you?
Very good indeed. You're looking sideways as though your kid's coming into the room and you want to tell him to get out.
No, I've just got some data up on the second screen here for our listeners today.
Okay, right, yeah. Okay, good. Yeah, you just reminded me of a parent who was worried that his kid was coming in the middle of an interview. Now, on screen, I've got a chart you sent us, and it basically plots the history of price movements from 1972 to 2020. What's the takeout messages from that chart?
Yeah, so 50 years. I mean, it's a big chunk of evidence, isn't it? The blue line going across the screen there is what the standard variable rate home loan has been over that period of time. You and I are old enough, Peter. Many others aren't. We're old enough to remember sort of the 18 to 20% interest rates. But here in Australia, the RBA has kept its powder dry, or certainly they haven't gone up for 11 odd years. So there's some people with a mortgage today who've never been through that. But it is absolutely incorrect for anyone who assumes that rising interest rates mean falling property prices. And you can see that interest rates have increased many times over those last 50 years. But the green columns show the combined sum of our capital city change in median house price. Those green columns in most years have gone above the horizontal. In other words, the property prices have increased. What I put in that red box there, that is the biggest, officially the biggest property boom in Australian history. 6-year window, 2002 to 2008. Not only did interest rates rise in that 6-year period of time, Peter, the standard variable rate home loan increased 22 times. In that same 6 years, 6 out of 8 capital cities, their median house price doubled, and more than 100 individual regional towns and cities, their median house price increased by even more than that.
Yeah. Okay, that's a very interesting chart, mate, in that respect. And the fact that even during the period where interest rates were 18%, house prices still rose. They didn't rise by as much as other times, but they still rose. Very good point. Okay, that's the first chart. Let's go to the second one. The second one, you've portrayed the potential for house prices, and your neat little aeroplane is pointing up. But at the tail, you've got the drag. Just run through the drag issues, and we'll look at the uplift issues that explain why you think prices could go up as opposed to collapse terribly as some predictions have been made.
Yeah, well, firstly, specific to interest rates, they're at an all-time record low. So the cost of money is dirt cheap. They went up, a week ago, and they're up. Undoubtedly, they're going to go up again. But there'll be a 15th more than dirt cheap. They're still going to be dirt cheap, right? We had directly before COVID, we have 5 RBA rate cuts. So they've got to go up 5 times just to get back to where they were 3 years ago. And 3 years ago, Australian mortgage holders, we had an all-time record low number of mortgages in arrears and an all-time record low number of bankruptcies. And Australia's economy is a lot stronger now than what it was 3 years ago. But an individual property market, so an individual town or city, there's always a big bunch. There are dozens of things that influence a property market, and interest rates are just one of those things. So when interest rates are rising, that has a dragging effect on property prices. On the left of this chart, I've written in a couple of things that are having a dragging effect on property markets for the foreseeable future. Most of it is just commentary. On the right-hand side are a big bunch of things, and there's a lot longer list than what I've put here in the orange text, but there's a big bunch of things that have a lifting effect on property prices. A couple of the most important things. We've got $230 billion in cash in Australian households. It's never been higher. Just in talking about our existing mortgage holders, in their offset accounts and redraw accounts, we've got $130 billion tucked away in there in cash.
And Simon, I think the latest number actually pushed up to 270. It was 230.
270, yeah, it was getting higher and higher.
Yeah.
Because we're earning a lot more than what we need.
Yeah.
And
we're spending less on services as well at the moment.
Correct. We're embracing technology. Things that we had to do in the past that cost a lot of money, we can do with a click of a button. We have the biggest ever investment pipeline for our infrastructure spending. We're going to spend $45 billion in infrastructure just this year alone, and our biggest year will be next year. Very important for property markets. We have an all-time record low number of properties listed for sale and, just as importantly, listed for rent. We always need to remember that an individual town or city is not a reflection of every other individual town or city. Sydney and Melbourne have had a return to equilibrium of their number of properties listed for sale. There's no coincidence that their property markets for the first few months of this year have flattened out. Let me tell you, as somebody who buys property for a living all over Australia, what's happening in Sydney and Melbourne is by no means a mirror image of what's happening elsewhere. What's happening elsewhere, there's nothing on the market, Peter. And when something hits the market, you've got multiple people still transacting in real estate and plenty of property markets that are running at somewhere between 10% annual growth and up to 30% annual growth. Why is that? Their local economies are incredibly strong. They've got lots, tens of thousands of jobs advertised, no one available locally to fill these jobs. Households are flush with cash, flush with equity, no stock to buy, and no housing stock to rent. So these are not bad fundamentals. These are incredibly strong fundamentals.
Yeah, and I guess, looking at some of the factors you point out that are clearly going to improve over the next year or two, we're going to have a lot more overseas migration. We're going to have a lot more foreign workers coming into Australia as well, which of course increases demand for rental accommodation, therefore increases the price of those properties. So it is an interesting, albeit a cartoon-like graph. It has a very serious message.
Well, and the thing is, I call it the metric of the moment, Peter. There always seems to be that one thing that's commented on a lot, and having a negative influence on property prices, and we gravitate to that. So if we go back 2 years ago, that one thing was population. We closed the international border, and so the metric of the moment back then was property prices are going to crash. How can property prices physically grow without having population growth? Well, large parts of Australia have seen between 30 and 50% growth over the last 2 years, the second biggest boom in this nation's history. But that was the one metric of the moment. Why they didn't decline, like everyone suggested, was because all of the other factors, well, most of the other factors were positive, having a lifting effect. So the one metric of the moment now is rising interest rates, closely followed by commentary about inflation. But the things we've just been through there show that the other things that are just as important, I'd argue a lot more important, are incredibly low. Rising interest rates. So we've actually got only this is an RBA figure, only 4.7% of Australian household incomes are required at the moment to support our interest expenses. That's not only a record low, that is like a mile lower than what it's ever been. So Australians are well placed to absorb the increased interest expenses as the RBA hikes things up. But we should be celebrating it. Yeah. Why do interest rates go up? They go up because we've got a really strong economy. Yeah. 430,000 jobs advertised in Australia today that can't be filled. We should be applauding that.
So, Simon, just as a humble economist as I am, I've noticed over the years, I guess it's 30 years of public commentary on the economy, that the real trouble for the real estate market is when unemployment really spikes. Is that what you have found in your years of watching property?
Yes, I can hand on heart say I've studied Australian real estate history to the absolute nth degree, and the single biggest influence, there's two single biggest influences on a property markets, and this is at a local level, not at a national level, is the local economy. If the local economy is strong, it's creating jobs, it's creating confidence, it's creating financial capacity. If the local economy is soft, the reverse happens. So housing demand is not a measurement of population growth, it's a measurement of economic growth. And the other thing that has a big influence on property prices is housing supply. That's a heck of a lot more important than any amount of population growth.
Yep.
We just don't have anywhere near enough housing, either for sale or for rent, in almost all of Australia right now. Record low stuff.
Okay, Simon, thanks for joining us.
My pleasure. Thanks, Peter.
That's Simon Pressley from propertyology.com.au. Well, a lot of people are worried that house prices are going to come off the boil. We don't know how big the fall might be. Some economists even think the fall might be really small. But REA has a service called PropTrack Housing Market Indicators Report for May 2022, and it is showing that a number of indicators showing that the market is coming off the boil. Let's just see what the true story is from Eleanor Creagh, who's a senior economist at REA Group. Eleanor, thanks for coming on the program.
Thank you for having me.
So, Eleanor, looking at this data, what are the key indications that this market is starting to slow and that might translate into lower prices?
Look, we've really seen that as, I guess, this cycle of exceptional price growth and exceptional buyer demand winds down. We have seen throughout April a kind of marked slowing across a number of metrics that we track at realestate.com.au. Number one I would pull out would be views per listing, which I guess measures kind of the aggregate buyer demand that is out there in the market versus the number of listings. So clearly we've seen that in this year to date across our capital cities, it's been the busiest first quarter for new listings in 8 years. So there's a lot more choice out there for buyers. And we are also seeing that demand is moderated, given the fact that we've got a lot of people out there expecting price falls. We've got affordability constraints kicking in. We've had rising fixed mortgage rates. And of course, the RBA set to raise interest rates. So the expectation of interest rates lifting off throughout April has certainly weighed on buyer demand. And we've seen that views per listing nationwide have fallen 8.8% month on month. Now, there are a few places where that moderation has been a little bit more intense. Those would be the larger capital cities, Sydney and Melbourne, but also Hobart. And on the flip side of that, we do see that kind of the smaller capitals where they're benefiting from that affordability advantage, the kind of lifestyle and preference shifts that we've seen throughout COVID in terms of bigger block sizes and the like Brisbane and Adelaide, haven't seen this moderation in buyer demand being quite so intense.
And because those bigger ones, including Hobart, they've had sensational price rises over the last few years.
Yeah, you're exactly right. So I think for a lot of people in particularly, say, Sydney and Melbourne, we have seen really exceptional price growth over the last 2 years. It's been a really unique period, I guess, in terms of that combination of factors that's come together with the closed international borders, more time spent at home, clearly record low interest rates and low mortgage rates, allowing people to service more debt. all underpinned by these ongoing preference shifts that we've seen throughout COVID. And this is still playing into some kind of relative strength in regional markets and the smaller capitals. So we're actually seeing that in regional markets, listings or the total availability of properties out there for sale for buyers to choose from are at around 40% below pre-pandemic levels. So that's kind of playing into this picture of, I guess, a little bit less choice out there in regional markets. And that's why I think we're seeing the price growth is still a little bit stronger in the regions relative to, say, the larger capitals.
All right. So you also made the point that there are more new listings on the market. Does that contribute to a degree to less views per property because there's just more properties? I'm thinking that if the same number of people were out there addictively looking at properties, but there's more to look, by definition then the views per listing could go down as well.
Yeah, exactly right. So I think for much of last year, we saw record high views per listing across really every state and territory. And that really reflected not only exceptional heightened buyer demand that was out there in the market last year, but also for much of last year, a kind of constrained level of properties available for sale because vendors were hesitant to list due to restrictions, lockdowns and the like. And that picture shifted quite dramatically in spring last year. And really since spring, we've seen an ongoing strength in new listings. And that's been certainly more prevalent in the larger markets, Sydney and Melbourne. So we've seen that the supply of properties available for sale has normalized much more quickly in Sydney and Melbourne, but also we have seen that sales volumes have slowed in Sydney and Melbourne as well. So versus the same period to date last year, sales volumes have actually slowed quite markedly in Sydney, and that's clearly with the strength in new listings and a little bit less absorption out there, feeding into a picture where really the total availability of properties on market is back up above decade averages. Whereas if we look at the smaller capitals like Brisbane, like Adelaide, where sales volumes are still tracking relatively strong, certainly compared to last year, certainly in Adelaide, we're seeing that sales volumes are actually quite a bit stronger than they were in this same period last year. And that means that we're seeing that really that kind of total availability of properties on market hasn't normalized quite as quickly. And actually the supply of properties for sale in those markets is still around 30% below the decade averages. And that's feeding into, I guess, this divergent picture that we're seeing in terms of those larger capitals coming off the boil with respect to price growth and market momentum a little bit more quickly than, say, the smaller capitals.
So when you add the views to the sales volume data, and I also notice here you're saying that the median number of days a property was listed on your website has gone to 35 days when it was 33 days. You put them all together, does that give you a strong belief that whether we like it or not, house prices, particularly in Sydney, Melbourne and Hobart, are likely to fall? Where is the jury out on, say, Brisbane and Adelaide?
Yeah, look, I mean, I think we're certainly seeing that the picture at the moment is one that is much less uniform. So we saw throughout the last year, as that really extraordinary combination of factors came together Australia-wide, with record low interest rates, low mortgage rates, people being stuck at home, all of those factors really created this quite uniform boom across the country. Whereas now we're seeing a little bit more divergence between the different markets. Some of the capitals are remaining I guess a little bit stronger for longer, you could say. Certainly Adelaide seems to be one of the strongholds with respect to momentum. Brisbane has been tracking much stronger year to date, but I would say that in April we have seen some of those metrics pulling back a little bit, and that kind of, I guess that lead is expiring somewhat. And certainly we are seeing a more marked slowing across the other capitals, Sydney, Melbourne and Hobart as well in the mix there, and Canberra. So it is a divergent picture. The uniformity of this boom is subsiding, and it does look like potentially those larger capital city markets will kind of head into the downswing of this cycle a little bit more quickly than the other markets. That's not to say that the smaller capitals like Brisbane and Adelaide are immune from price falls, but I think there's still a lot of uncertainty out there with respect to kind of how far and how fast the RBA are going to raise interest rates, and obviously the knock-on effect that is going to have on the housing market.
Okay. When you read economists and other predictors saying that house prices could fall 20 or 30%, what do you privately think? Now share your private thoughts with us, Eleanor. I don't want your politically, socially aware comments. As an economist, when you hear it, you say, BS, ain't gonna happen. Or you say, yeah, that's on the cards.
Look, I wouldn't say that was on the cards. I do think there are scenarios where we could see a more moderate pullback in housing prices, a kind of more orderly correction. Certainly the last 2 years have been absolutely extraordinary when it comes to that combination of factors that have really come together. And we saw that last year was the third fastest pace of price growth in more than 140 years. What would actually be surprising is if we had kept that up. So I think, we're entering a much more normal part of the market cycle. It wouldn't be out of the realms of possibilities to see a kind of correction in housing prices. But I think what we can't forget is that for a lot of people, that correction, say a correction of around 10%, something more kind of orderly, would take prices back in most capital cities to levels that we saw last year. So there are going to be a lot of people that are going to be able to withstand a moderate fall in housing prices. But I do think that if we were to track along that scenario where a 30% fall in housing prices was on the cards, it would only be a matter of time before the RBA reversed course and were lowering interest rates again. You know what I mean?
Yeah.
The RBA are very cognizant of, I guess, the impact on the economy that large outsized falls in housing prices would have. It would move them further away from their full employment objective, and it would put the economy back into reverse, which is not what they want to do. The RBA are at a position now where the economy has strengthened, and they want to, I guess, wind back some of those emergency policy settings that have been in place and have supported the economy throughout COVID. They don't really want to put the economy back into reverse, if that makes sense. Yeah. So I think if we were to start tracking down a scenario where those housing price falls were becoming, quite negative, we would certainly see, I guess, a change in trajectory with respect to interest rates and with respect to monetary policy in terms of supporting the economy to get back on track.
Yeah. And I got to say, if house prices fall 30%, Eleanor, I will be buying property. That's for sure. I will be. If it wants to drop 30%, I'll be a buyer. Thanks for joining us on the program.
Thank you for having me.
That's Eleanor Creagh, Senior Economist at the REA Group. And that's the show for this week. Thanks for joining us. Don't forget, if you want more information about investing in stocks, have a look at switzerreport.com.au. And if you missed my interview with Chris Joy about whether markets will crash, house prices and stocks, have a look at my Monday show. Quite an interesting interview. It might actually have a big impact on the way you invest in the future. Thanks for joining us. See you on Monday night.